we'll call it 20 days, 25 days, something like that. So I started with just a normal strangle. I sold the 92.105 strangle. You can see the stock price on the market snapshot page trading at 97. So a little bit of upside skew here, which is why the call was a little bit further out of the money. When we look at the delta slide, you'll see I started with basically zero deltas. So just a normal strangle, I guess, a little bit shorter duration with 29 days to go, but no biggie there if you're comfortable with the risk. Over the next, week and a half ish, you had a rally in the stock up to 92. So it's rallied about five points, rolled up that put from the 92 to the 97 strike, collected 98 cents, right around $1. Again, high premium in this underlying, $4 on entry, $1-ish on the roll up. Again, on the third adjustment, another roll up. So you see the stock has moved from 97 to 107. It's a 10% move in the stock price, over 10% move in the span of 2 weeks, right? So outsized move for the stock, rolling up the puts, just being mechanical here, getting to that tight strangle slash straddle that we call the guts. Right? So you're getting to that kind of at the money position. The fourth adjustment is when I buy the guts and sell the wings. And we'll see that on the third slide when we get to it, because I did this in two separate transactions to kind of highlight the adjustment.
Fair enough. And yeah, really just looking at the way that this thing has moved, and you can see it moved from 97.5 to 107.5. I mean, you should expect these kind of movements with a high IV stock. Yeah. It's pretty rare where you have high IV and it doesn't move at all. You should expect some chunks here and there, but you're getting paid to take the risk in being involved in those chunks, I guess you'll say.
Yes. All right, so jumping to the next slide. So this is the delta of the position and the adjustments that I'm making. So you can see I start with basically zero delta, right? It's I think I was selling maybe the 25 delta on either side, maybe the 30 delta. It doesn't really matter. Position's flat. Next adjustment, the stock or the position has a 15 delta. So I'm reducing that by 15. The third adjustment, again, you can see the position's delta isn't getting to 100 or 50. We're sitting around 10 or 15. I'm leaning a little bit directional into the move in the stock. And you can see on the close of the trade, I'm getting, pretty heavy delta. That's when I decide to take this position and roll it out in time, which is what we'll see on the next slide here. So here, the position on the bottom, the 102, 105, that's the guts trade, right? So when Tom says buying the guts, selling the wings, that is the guts part of the position. It's an at the money position. The stock is trading somewhere around 103 or 104, whatever the case may be. It's right at the money. I'm taking that position, that at the money strangle, and I'm rolling and selling the wings, right? I'm going to a new position that's further out in time, going out on the curve, on the extrinsic value decay curve, and getting a position that is further out of the money. I'm doing this whole transaction. You can see I did it for a small debit. I did it for a debit of 40 some odd cents, 47 cents here. But I'm essentially moving that at the money premium, which is going to be slow to decay and is going to move quicker because it's in the shorter duration, 11 days at that point. I'm rolling that to out of the money premium on the longer duration here to a new position. And you can see it establishes back my zero delta. I'm going from a position that was slightly short delta to now a flat delta position further out in time, that out of the money strangle.
Love it.
And then when I close the position, you can see over the next week, the delta of the position didn't change. The stock floated around, right? And that would have had a big change in my delta if I had stayed with the position, because the stock got up to like 110-ish was kind of the high. It's trading at 105 right now. So if I stuck with the 102, 105, I would have been 70 deltas short into a move to 110 with just a couple days left to go till expiration. So you can see over the next week, even though we had the price movement, the delta of the position when I closed it yesterday, when the stock was at 107, was basically still flat.
Yeah. And avoiding doing your best to avoid those tough decisions. I don't think we talk about that enough, but like sticking with the 102, 105, basically a straddle. If you get a big move against you, now you're kind of pushed into a corner and you're like, okay, what am I going to do now?
Yeah.
Where understanding that you can move from the 11-day to the 30-day and basically turn your 3-point wide inversion into a 25-point wide out of the money strangle range.
I wasn't inverted, but tight. Right at the money.
Yeah. Basically a straddle.
Yes.
Going from a virtual straddle into a 25-point wide strangle for ultimately a scratch, we'll call it.
Mm-hmm.
Buying it back for 555, selling for 508. Now you put yourself in a situation where you can absorb a lot of volatility and you don't have to make these tough decisions.
Yes.
So I think that's another thing that we should bring to light. But I'm very excited for the last slide because this is just work of art.
Yeah. So here is visually what buying the guts, selling the wings is doing. So you can see the value of my position in terms of credit isn't really changing. Right. So like the break even point from where my short strikes isn't moving because you're doing this for a net small debit. You can do it for a small credit, or maybe you get, you do it for a scratch. It's a negligible amount. So it's not adding potential value to pull from the trade, but it's moving where my risk is on the trade. If you would kind of, you would think that I would get maybe $3 or $4 of premium if I had just rolled out in time to the at the money straddle, which would put me at a pretty wide break even, but that position wouldn't decay as quick as that further out of the money position, the wings position in this case. So you're moving from that very tight range to a much wider range to allow for some price action in between.
Yeah. And one thing will always ring true with these visualizations that we do with undefined risk short premium trades that we're rolling, and basically we're moving these break evens wider and wider and wider because we're staying in the trade, we're collecting more premium. We can adjust our strikes as we see fit wherever we want to move our risk, but at the end of the day, as long as we're picking up credits and not paying debits, our break evens, the green dotted lines here, are going to continue to just move further and further from the stock price, which means over time we can absorb a lot more volatility and we'll still be okay in the sense that our credit is greater than the volatility that we're absorbing, and our break evens just get further and further away. And when you put yourself in that scenario, assuming you have a stock that has two-sided action, it just makes it a lot easier to be profitable at the end of the day.
Let's see what we got. Okay. What's up there, Brother Will? Good to see you. Yeah, I was just going through. That's one of the Tasty Trade screens, and I really dig what they do. I really dig. So we got 3 positions that got filled yesterday. 3 of them got filled up because we had 1. So we're going to try to get the other 2 filled today. So let's go over the inventory. Our deltas, with the exception of FXI. FXI deltas, it's not terrible. It's just, it is what it is. This is one of the ones that got filled yesterday, Strangle. Let's see what he's like on the hill. It's down 16 cents. Where is he literally sitting on the hill? Yeah, he's in the middle of the hill because we just filled that yesterday. So I don't mind if it goes down a little bit. It makes a little bit more profit. But again, this is a strangle trade. You just, sit on it. So our inventory got filled yesterday with 3 trades. We're going to try to fill some more. And, so basically they're basically all pretty flat in terms of, just because markets are open, they just open. So there's nothing really major going on just yet. So, and I'm just looking at our deltas. We're good there. The trades that didn't get filled, the other part of the other part of the inventory. Let's see if we could find the other part of the inventory there, Brother Will. And okay, let's go to there's activity, TLT. Where else didn't get filled? GDX. I really wanted GDX and TLT and SCX. These are the 3 trades that I wanted to get filled, but they didn't get filled yesterday. We got filled in SLV. And so that's two deltas. Okay. So FCX, Freeport McMoran. No, that was the one that had earnings. Yes. It had earnings. And that's why, when did they have earnings? I think today before the market. Let's see, when did they have earnings? 1024. Yep. They had earnings before the market. So look at that IV rank. It just went down to 3. So a trade that was selling for, that we were trying to get filled for 112 is now costing 105. So it, it wouldn't have been like all that, or no, it's actually costing 112. So literally there wouldn't have been a price drop in terms of volatility for earnings. And Freeport McMoran is down. Where is it at today? Where's FCX at? 47.47. So yeah, it's down a little bit. I mean, just 40 some cents. So our deltas, we would have been okay. Would have hit us delta wise. So I'm glad that I didn't put that on, because I think they had earnings this morning. And let's take a look at the chart, because that was the one I took off because I didn't see the earnings situation. Let's go to a 5-minute chart and let's see what we got market wise, because it should have had earnings earlier. And I'm looking at the earnings calendar on Tastyworks, and it's showing that there's no triangle there. So I'm pretty sure it had earnings before market. So let's see. Yep, it had earnings before the market. As you see, that when you see something spike like that, that just tells you. But look at the IV rank. So all the implied volatility is out of the trade. But the funny thing is, it really didn't impact the price, because we were trying to get it in at 112, and it's only 11 cents down. So yeah. So I'm not gonna freak. It's just one of those trades where it's like, I just wanted to get some credit, and but I didn't want to be in during earnings. Let's go to GDX, but Broken Wing Butterfly. Then it should have no risk to the upside. We were trying to get 15 cents, and so it's 15 cents. Cool, because it is down 42 cents. So we might be able to still get in this. We're only getting like 24 cents a day in theta, but the probabilities of this thing going in our favor are quite drastic. Let me see where it's sitting in terms of GDX if I really want to take this trade. I mean, I like to see where it's sitting in conjunction to the hill. And buying power, it's $85 overall. If it goes underneath, if it goes underneath 38 by expiration, then that's when we're going to lose the whole thing. But I like to monitor this thing. Should it go down to 39, I want to, I get very, very critical monitoring it, because then, we're looking at, then we would be looking at taking profit on the again, the other side of the lawyers. Like I said, this is your client. This is the lawyer that's closest, the lawyer that's longest. And since it's, okay, 16 credit. Let's see how much credit can we get on this. 16 cents credit. Cool. So it's even more than what we were asking yesterday. So we're just going to see if that market will come to us. I have it at 19. Now credit is rising, which means that this thing is falling. The more it falls, the higher the credit you get, because you're getting paid to take the risk. And let's take a look at the chart of GDX. This is one of the trades that didn't get filled yesterday, but I'm trying to get it filled today. Okay, that's a 5-minute chart of GDX, and it's just collapsing. Let's take a look at the daily, because that gives us some insight into why it's giving us more credit. Because the closer it gets to our short strikes, the closer it gets to the peak of that thing, the more, okay. So this thing could easily fall, and I'm looking at, this thing could fall, and it looks like it's wanting to fall. If it gets to 41.96, it's 42.71, which I doubt it would get all the way down there. But if it does, we would possibly get that credit. Now, right now, I'm looking for 20 cents. Okay, it's going down. It's going down in terms of credits. I'm going to see if it'll come up to 20 cents. What that is if this thing starts to fall, the closer it gets to our peak right here, then of course the higher the credit. So I'm going to put that trade in just in case at 20 cents. And because I don't like to do anything under 20 cents. Main reason is because commissions, that'll, if all things expire worthless, I could take care of commissions. So let's make sure we got that trade on the GDX, and that's a 20-cent credit. Yep, it's now trading at 18, 20-cent credit, and our buying power is around 80. So that's cool. All right, what was the other trade that didn't get filled? So if we could get all these, and I could pay my Tasty Trade commissions, because I do not mind it. My thing is Tasty Trade, fill me so I can get you guys commissions. Fill my trades so you guys can get the commissions on it. I'm trying to put a lot of trades on, but I haven't been getting filled. They don't want any money over there at Tasty Trade. Here we go. TLT. We'll get, 11 cents. So that really didn't move much to where it's moving against us. So the prices, again, I'm playing this as if there's no risk to the upside. We were looking for 11 cents. We're only really going to get we're at 11 cents credit. So you know what I'm going to do? I'm going to go up and see if the market will chase us there. We'll go to 13 cents. No, we'll go to 15 and see if the market will, if the market will chase us. What I mean by that is bonds falling. Right now it's only up 3 cents, and it can't hold that upside movement because it was up 5 cents. So this thing can collapse even further. The more it collapses, the higher the credits that we're getting. Right now it's still, the mid price is at 11, but if it starts growing in this mid price where it says mid, not the natural, but the mid price, if it starts going up, then that'll tell you, look, like right now it's 12. That means that the price is now falling on bonds. Remember, it was up +1, now it's starting to fall. The more and more that starts to fall, the more and more it'll get closer to our where we can closer to our area of and we don't want it there at that peak. We just want it to fall a little bit to get filled. We want it to expire here, worthless, and inside here, which is like a damn near, for entire profit, damn near impossible. 86 is our point where our break even. Where's our break even? Let's check that out. I think it's 86. Is our break even? It's at 92 right now. Break even is around 86-ish, 85 something, somewhere around there, 85, 86. So, we still got some ways to go. So we're going to put this trade on and see if the market will chase us there. And if not, I'll just back off my credits a little bit. So we got that trade on. Let's go to KRE and see what KRE, if it's done anything in the last 2 days. Okay, and the implied volatility is very important on both GDX and the ones I just put on, to make sure that the implied volatility is not, it hasn't fallen too much. That's very important. TLT, let's go to TLT and see what the implieds are. Oh wait, there we go. TLT, yeah, see, it's still got a lot of implied volatility. GDX, 48. So it's still, it's still got some implied, so we're cool. KRE, what's the implied volatility? Yeah, it's still up there. So it's still sellable. Let's go in and see the trade that we were on. Once we do that, so we got orders in there that hopefully will get filled. And then, because if we could have like 9 or 10 different trades going on, we could fill all these orders up and then just manage them during, and then as we manage, we look for new trades. It's like an assembly line. It's just real, very systematic. So let's check our inventory. KRE looks like it hasn't really gone anywhere. We were asking for $1.19 credit, and we're getting $1.19 credit. So it hasn't really gone anywhere. The thing is again, if we were to move this short strike, should the market go against us, it'll increase the buying power quite precipitously. So we would definitely, this is one of those, higher net worth trades, but I'm going to keep the screen open. Okay, let's look at new trades. So, and here, we didn't see the state of the markets. So state of the markets, SPX is up, I think like 12, 15. No, it's only up 9. So basically it's a flat day. Let's go to fear, VIX. Oops, let's see, VX. VX. Fear, 10-cent change. It's only down 10 cents, pretty much a flat day. Bonds. Where we at in bonds? Bonds is up a tick, so that's pretty flat. I think, so basically it's a very flat Thursday. So there's not really much in terms of any, so let's see if there's any opportunities, any new ones. High volume ETFs. Usually you won't find them unless something happens market wise to cause that. So we'll check that out, see if there's any opportunities here. And then we'll go, give me 1 second. Okay, we're looking for opportunities to sell volatility in terms of, again, looking for volatility to sell. You need high volatility because you want expensive volatility to sell. And then I'll run you over a trade of cheap volatility so I can show you the other side of still income trading. You're still looking for income, but you're not selling the volatility, you're actually buying it. Because you could also get income with trades that are buying volatility. So we're going to go through that and just continue to. So we got some trades on. We got some trades that are in the queue. Now let's go to any new opportunities coming in. Let's see, DIA. I look at the IV rank. I listed by IV rank, and it's listed by IV rank. So SOV, we already got a trade on there. Since we've got GDX, we don't need GLD because that's gold. EWW, I've been trying to get into that, and that's still going up. So let's see what EWW. The only thing is it didn't have weeklies. I don't think this one had the weeklies. So the liquidity is really, look at that. There's really no liquidity for December because I need to see liquidity for me to trade it. So EWW, it's not necessarily one I would put my hat in because you want a full deck of you want everybody, you want the whole party in. SMH, that's a pretty expensive stock. USO down 9% in volatility. That is definitely not something I look at. And the rest of these are XOP is on the fence in terms of possibly tradable. The referee down 0.1% makes me go, But XOP is possibly, which is oil and gas ETF. But if we did that, let's see what we would look at going into December. Let's put our fence up there. 18 is the closest to 16 on that, and 17 is close to 16 here, and there's upside skew. You could tell by how far the delta is from the expected move because they're expecting a $12 move, which is usually where that red line is, off the red center thing. The market, the fence is close to that side, but look how far it is away from here. So definitely it has upside skew. And you can tell here again, looking at the upside skew by, we're going to do this, by just looking at it, you could tell that this is a lot, the mountain, the little curvy mountain and the strict mountain, the square mountain. The distance between that little area, which is what we shorted in here, is just a little bit bigger than this. So if we go here and look at that, we're looking at this thing, if it got up there tomorrow, we would be down $400 there. If it got down to here tomorrow, we'd be down only $258. We'd be down if it just shot up there or shot to the other side. And if you look at the deltas, 0.31, we're pretty much close to delta neutral. If you took this trade as a strangle, you would be you'd have a 84% chance of making 50%, which is $1.50 or $150. You make $7 a day in theta. You have a 71% chance that this thing will make you a penny or more at expiration. If we look at the mountain, it is kind of a steep mountain, because we're out of that 300 right there. If it got down here, we'd be losing over half. We'd be losing like 60%. It would be 60% of the buying power. If it shot up here, we would be losing the entire buying power, and then some we'd be paying because of the upside skew. Plus, the buying power is $1,300, and I'm not willing to spend $1,300. So, what would I do in a trade like this? Because I don't care whether it goes up or down. We look at a chart to see. Wait, that's news. Let's go to chart. If we look at the chart, XOP is just basically ranging. It fell quite a bit. That little gap. Gaps usually like to be filled, but markets are markets. They do what they want. If it ranges out a few more days, because we're not going to be in this thing very long. We don't want to be in this thing more than 2 weeks. So that's 14 more candles from this. So we could look at the range of where this thing has been in 14 days, and so it's been kind of a chunky range for like 14 days. This thing can move about $5. We'll go $5.50. This thing can move $5.50 because on the ATR, which is twice the ATR. So I always double the ATR to say this thing can move $5.50 in the next 21 days. I'm saying the average movement of this in 21 days, doubling it, is about $5.50, almost $6 that this thing can move. Not to say it will. A lot of that was attributed to this gap right there that caused it to say, okay, now we're going to push our averages up. Implied volatility in terms of its IV rank is definitely starting to go down, but I'm not saying it's going to continue to go down. Usually when the market rises, implied volatility goes down. When the market goes down, implied volatility goes up. That's only for commodities, gas, oil, soybeans, stuff like that. But for stocks, it's the other way around. So we got that. Maybe this thing will range just enough for you to go ahead and see if you can make a profit in 2 weeks, but we're going to check it. Okay, our strangle is the 120, 149. We can move this to 150, and we'll get just a little bit less, $12 less, which is okay. If we move that, because then we're giving more room, but even though it's going to cost us for that little bit of room, we're just giving the market more room in case it wants to spike. Because remember I said, because of that gap, markets love to fill gaps. Not to saying it will. So if we were to go back at 281, let's go back 2 weeks. We went from December, we'll go back to November 29th. We'd be 188. Ooh, wait, let's see. Let's double check it. Yeah, I don't mind that. So from December 20th, 146 is 150, 120, 150. So 120, 150, 288 is what we could possibly get. I mean, that's the credit we'll get on this. If we did this, we have 86% chance of this thing being, making at least 50% of this. So that's $144 that hopefully we could get, which is 50% of that. So if we back this up, the 120, 146, in 2 weeks, we would have made about, say about $100 on this. And let's see if we can move this to 150 just in case, because I want to move that to 150. Okay, there we go. 161. So we would make about $120 on this thing. I mean, that's if this market didn't move and all things being equal. But it just shows you that there is an ability to move that back to 150. There is, this is a good trade if I wanted to spend $1,300 of buying power. I don't want to do that. We've got our 16 delta here. We've got, so all the things, the only problem that I don't see is liquidity. 43 contracts there, 40 contracts. So we do have some liquidity. This is an ETF, so we're not, it's not like the best. I want to see thousands of contracts. I'm not going to see it here. But if I wanted to do an iron condor on it, we'll go to the 155, $5 away. 120, 115, $5 away. If we did $10, it would, again, the buying power would probably double on us. We're looking at 311 in the wheelhouse of buying power. If we went $10 away, we're getting more like the strangle, and let's look at the hill. So 150 to 160. That's a $10 away. We don't have any liquidity, just barely any liquidity up there. We would be getting, it would cost us $8.15, and we're only getting $1.85 for, so at $8.15, we're only getting, less than, one, what is that? 1/8, okay, 0.125 of the credit, or 12.5%. That's all we're getting on this. I can't handle that. So let me see if we could, even though if the more shorter you move those strikes, the more you're going to be, the more you'll have to hold this position to get that full profit. So this is one of those things that, since our protection, i.e. the strike, remember these are the protection on iron condor, we won't be in this trade very long. Good thing is you're getting 117 on 383. It's not a whole full third of the width of the strikes, but it's okay. It's not great, but it's okay. Again, I always look at a trade like the moment I get in, I know I'm going to have to adjust it. I just know that. So I would have to adjust this thing due to the fact that I know it's going to move. That's the first rule. When you get in a trade, know you're going to have to adjust it. But at least you're going to get like 118 or whatever on this. If we were to move this back in time to see how long we would have to be in order to make our 50%, if we move this, see 115, 20, 150, and 155. So if we move this back in time to November, let's see if we could go back in time and see if it'll work. Let's move this right here, because for some odd reason it stacked the strikes. And I noticed that it does the same thing with Thinkorswim. So 115, 120, what was that, 145, 150, I think. Let's just double check. Get rid of that. 15, 120. I think it was 145, 150. Like I said, it's a pain in the ass when it does this, but it's just the nature of the game. So 71 cents, I think. Okay, so let's go back to December and double check those strikes. So December 20th. Okay. Or are we not? Let's see. Let's do that. See, expirations, December. There we go. Come on. Why am I not able to go all the way up to December? Come on. And I don't know if it's my computer or if it's the platform. So, because all of a sudden it's not moving when I hit expirations. It moves back, but it doesn't move forward. Is it my memory? So let's go ahead and clear that and do that again. We'll start it again, because I'm not able to move strike. So 115, 120, 120, 115. And then we've got 145, I believe. Was it one? No, it's 150. 150, 155. That's what it was. 150, 155. So I think, or was it 145, 150? No, it's 150, 155. Because we're out at the deltas. So 50, 55, 15. Okay, cool. So let's see what would happen. See if we could do this again. If we went back to November, all things being equal, and we go back to November, and let's change this. Let me let's see, 120, and that would be 155, 150, excuse me. Man, all of a sudden this thing is just sluggish. It's kind of weird so let's go, oops, we don't want to do expirations. We want to do prices, strikes. So let's go, so 115, 120, then we go to 155, 150, excuse me, on the top, 146, strikes, move that up. Okay, wait, that's 155, oops. This is the call we're buying. No, this is the call we're short, so 150, 6, 7, 8, 150, and then the call we're buying is 155. Easiest way to do it is just move it up there. So if we went back, it's showing 26 cents. Nah, it would definitely be much more than this. But again, we don't have pricing because there's not really any trades going on there. But I'm just saying theoretically, it should be, and that's going back 2 weeks. Trying to price it with no volume is like, I won't say impossible, but it's close to. But it just tells me if I move this back, what kind of profit could be made if I did the same trade and moved it back 2 weeks. So, but let's go ahead and move this to December. Kind of like an XOP. I was having some major hard times trading it earlier this year. So 150, 155. Yeah, this thing is doing it again. See 150, 155 in the call side. Okay. So yeah, because we're in the wheelhouse of where our deltas are. So let's go to the put we're buying and put that back to 115. Okay. Okay. So 117. Between the mid price and what the ask is, we're looking at from like 117, and the price that you want to sell it at 134. I'm gonna see if that market will come up and try to fill us around 122 to 123, even though I know it won't. Again, we don't have much liquidity, so it's not like it'll get there, but I'm just gonna put it up there. And then I come back to it and see where the market moved, and then I get real close to the mid price. So I do kind of like XOP. I kind of like that trade. It's 300 buying power. I know I'm gonna settle at 120. I have it at 123 right now, but I'm gonna try to settle like 119 or 120 because it's trading at 117 now. So I'll try to settle at that, and which is 330, and that's not exactly 1/3 the width of the strike. But if I got this price, I'd have an 82% chance of making 50%, which is around 61 dollars and 50 cents, and then probability of profit of making profit on this is 67%. When I say POP, we're talking at expiration. If all things being equal, I know I will have to. This is a trade without a doubt you will be adjusting. So I always look at the adjustments. Now here we are toward the bottom. I mean, we're closer to the just a hair bit, just a fraction closer to the lower half. But remember, this has upside skew because if the market was here and it went to our short strike, we'd be down 97. If it went there tomorrow, we got filled. As we go to this short strike, we'd be down 73. So that is literally like a damn near 20, no, about 18%, no, 17% shifting, or 17% difference in our risk, i.e. the hill. But I like this trade, so we're going to fill it. Okay, now let's go to stocks. Again, this is just pure income. This isn't speculation trades yet, except for the GLD and the other one are a little bit more bullish. The butterflies, the ones where I had the lawyer, you had P. Diddy, and then you got the lawyer that's closest to him, and then you got the lawyer that's furthest away. Those are more speculative. Okay, those are speculative trades, not as much, but still yet they are for income, income-driven trades. So let's go to stocks and see. Yeah, we're on high options volume. That's what we want. High options volume. So what is PTEN? Patterson. I don't know what it is. It's down. So it must have had earnings. It's down 6%, but I don't care because I've never heard of it. Don't trade it. Bank of America. Boeing. Keep saying Bank of America. And I don't think I have any airlines. I was trying to get some airlines, or do I? Because I've really been digging airlines. I've been doing good on airlines in the last year. Yeah, I don't have any airlines on. Okay. Nope, no airlines. And we're still flat deltas, except for FXI's deltas getting a little more long. So it's down 33 cents, but I'm not going to panic. That's only 7 deltas. So let's go in and find. I like the Boeing. The only problem with Boeing is it's down 4.6%. Did it have earnings? No, I don't think so. Those airline earnings are usually first. So I think, no, it's bank earnings I'm thinking of. So anyways, Boeing does have high IV. It's just the implied volatility has collapsed, in the last 5 days. So why would I get something that I'm selling cheaper? Walgreens Boots down 10% in volatility. There's no way. GE 5%. Did that have earnings? Oh, wait a minute. Nope, no earnings. American Airlines had earnings this morning. What's going on with American Airlines? How far did that fall? Okay, we've got earnings. Yeah, it had earnings. No, it didn't. The Apple has earnings today. Yeah, it did. It had earnings this morning. So let's see what happened to American Airlines. So it spiked, and now it's really gone nowhere. Okay, and I saw Delta earlier. Delta Airlines. I really have been okay. Delta's implied. Look at that. It's just gone up and up. I've had really good luck with airlines. Not as much as with banks, but Goldman Sachs is up 0.9% in volatility. Delta. Let's see what we got in Delta. See what we got on Delta. Let's construct a trade for income. Construct a trade. So Delta. What do we got? Okay, let's get down to the 19. So we'll go 19 deltas. 19 deltas. Again, there's a slight skew to the upside. We're almost totally delta neutral. 89% chance of making 50%. Probability of profit is 70%. I already like this so far. I'm looking at it. I like it. So, but there's no liquidity. That's the only problem. But that just means you're going to be paying more for the trade. Remember, slight skew. If we jetted to the upside overnight, we'd be down 232 and crying. If we jetted to the downside, we'd only be down 120. So there is upside skew to this thing. In terms of how much it moves, this thing can move $3, easily $3, because I'd say the average of $3 in the last 21 days. And if you look at these large candles, it's telling you it can move. What is that? From 53 to 56, that's $3. 50 to 53, that's $3. So this thing can move $3, and that's the average in the last 21 days. So this thing could go from 55 to 52 right here, like it's nothing, or 55 to 58 up here, like it's nothing. And and so your deltas, you would definitely be, if it shot up there and moved those $3, you would definitely be having to adjust. Remember, I always think about adjusting. If it went up, the purple line is your deltas. If it went from where it's at right now and went up to $58, you would be 29 deltas short. So you would definitely, and that's just with $3 movement. And like I said, I always double it every time. This thing pays you $3.08 a day. Buying power is $541 buying power, but you're not getting the full third. So so the buying power is inhibiting you from getting what you want. That's the only problem, because I if I got like $100 more, then I would be looking at this trade, because then you're getting, again, I don't look for just a third of the risk of the width of the strikes in terms of iron condors. Most folks trade straddles. They'll be satisfied with 10% of the buying power. I want more than 10%. I want at least 20%, 30% is my wheelhouse. And that just means I'm selling it for a lot of credit for the risk. So anyways, we're looking at this. We go to the table. Okay, a 48. Let's see if we went down $5. There's no liquidity there. If we went down 1, 2, 3 on each side, 3 on that side, 62.5. We're going to back this to 60. Well, we can't. We'll have to do this in $5 strikes because there is no the granulation. It goes from 60 to 62.50 to 5 to 65 to 70. So if we brought that into, again, but there's our delta. We're at 27 deltas. So I would not do this trade. Would not do it. There's not enough liquidity because the granularity on strikes is not there. On one side, it's going up by dollars. The granularity is by dollars. And on the other side, it's, again, because of the risk, it's $2.50. And so the granularity is not there for me to be able to take this trade. It wasn't like there the other day, but it's there now. So, if I did this, and plus our delta, I would have to move this to 62.5. There's no way I'd go to 27 deltas, because remember, the probability of touching is twice the deltas. So if I went to the 27 delta, which is one above the red, that means there's a 54% chance that the market's going to get there, at least sometime before the trade is over. 19 says there's only 38. So the difference between these $2 moves is quite a lot in terms of this market touching that area. If I wanted to do this, I could go $3 down, $2 up, which will it's an unbalanced. We'd 74, and then the cost is 227. So that gives us the width of the strikes, 1/3. So we are getting paid for that in terms of credit. If we went over here, 80% chance of 50%, 64% probability. Because of the granulation, if I back this up, I seriously doubt that we'll be able to replicate this in terms of the strikes going 2 weeks back, but we'll try it. So 45, 48, 62.5, 65. 45, 48, 62.5, 45. Okay, this is close enough. So we would have made 30%. No, not even 30. We'd made about 1/7. So we'd only make about $10 if we went 2 weeks with this trade. It pays $1.45 a day. So we'd probably make about $10, just sitting on this thing for 2 weeks. The theta is not worth it in terms of the theta. So it's really not like the best of trades in terms of it really isn't the best of trades. But I'm gonna sit on this just in case. It's just you'll have to hold it longer than 2 weeks in order to make that money. And I like to see what would happen in 2 weeks. If we were to hold this, remember this thing, if we held it in 2 weeks, that would be November 29th. And what would happen? How far do they expect it to move? November 29th, they say this thing can move $5 either way. November 29th. That's how far we would hold it in order, the very shortest time we could hold this to make something substantial would be November 29th. If this thing can move $5, it could literally move down to where we are either long 9 deltas or short would be short 6 deltas. Long 9 deltas or short 6, long, or this that short, short, and or short $7 in profit. Long 9 deltas or up, we'd be Yeah, no, we'd be long 9 deltas, 9 10 deltas short. We'd be short 7 deltas. So, again, it's one of those things where this is not like the most grandiose of trades. It's just another income driven. You're not going to make a lot of profit. You'll have to hold it longer, but because of that, I want to see if I can get paid for the problems. So I like to move this up and see, where that market is. And I would buy anywhere between the 75 where it's at now and the 87. Again, look at how far that is. That's like 12 cents between the mid price and the ask price, which tells you that, there's not a lot of liquidity, number one. And if I wanted to do this, I want to get paid for my troubles. So Delta Airlines, we're going to keep that in the wheelhouse. Next, we're going to go in and see. I haven't done Taiwan Semiconductor in a while, but yet it's 5. All these have collapsed in volatility, so they're not worth selling. NASDAQ. Okay, let's see. The implied is, we don't care about volume on indexes because they don't have it. Implied is 22. So this would be something that, the IV index is up 37, but the IV rank is up 37. The IV index is 22. They're kind of fighting each other because you want a low IV index and a low IV, a low IV rank. So they're both fighting each other, but I wouldn't, if I were to do this to try to buy a trade, again, buying volatility is the opposite of selling volatility. So if we were to buy it, we look for lower things that are low volatility that were more than likely going to go up. Let's take, let's see if we could find one that is lower volatility and lower index. That XOP is like the very, very, it's like skirting the very, very edge of selling volatility. But these over here are low volatility. Let's see what we would do. Let's go with, look at that emerging markets, man. It collapsed like crazy because it was way up there. Let's go with Verizon. I would rather do an index for Butterfly because, they don't move like stocks do. So let's take IV rank, the lower IV rank. We're there. EWZ looks like, look at that. IV rank is only 3. The only thing is it's fighting it is we're almost 30 on the IV index. So we're really fighting that. EEM, I'll just show you just, in terms of, I'm thinking that EEM, although EEM is up 2.5% volatility, it's, you want a volatility that's red, that's falling. That's the key. You want it red this time, and you want low volatility because you want to buy something that's cheap. But if we looked at this EEM, chances it's still up there. In order for the volatility to go up, you want EEM to fall because that, look at how volatility also fell as these are getting smaller. It's, the green and red line are volatility and it's fallen. This thing has the ability of moving a dollar either way or whatnot. So what I would do is say I believed I wanted to get income on this trade. Since we're not selling income, we're going to look at buying income or buying it. So if we were to do this, we would do a trade that would be like, say, when you're buying the volatility, you want that market to move there quick. So you're not going to buy a volatility trade that's going to be out. You would rather that market move so you could keep your intrinsic value of your long strikes, because this is a horizontal spread. We're going to have 2 different months, and that first off, we're going to look over here at the IV index, and we don't see it collapsing in volatility until like this December 6th thing is weird, but it's pretty much flat. It's going up just slightly in volatility, which means that your long strikes can retain their value. But you want to sell the short ones. Like I said about the milk, you've got the milk that's expiring and the milk that's not. If we went and did like a month calendar, and I would do like maybe a double calendar, I would say, let me go, instead of going all the way out here to the fence, since I want this market to move, I want this thing to move. And I would rather it move to where it has at least, instead of the 16 delta, which means, again, the 16 delta means it's a 32% chance the market will get there. I would rather have a higher chance of that market either staying where I'm at or moving, maybe not that far out to the 16, maybe 20, 23, somewhere around there, because I want to move my fence in just a little bit. I'm buying volatility. And again, I don't want anyone to breach my fence, but the cows are very cheap. And the longer they stay within that fenced in area on the hill, the more that, I'm basically wanting the cows to stay in, but I want volatility to go up. I want wolves and stuff to be around the fences. So what I would do is I would have a fence that I would literally do like the expected move. How far do they expect this thing to move between now and November 15th? Another thing is I don't want to be in this trade till November 15th. I would rather be out of this trade no later than like a week, 2 weeks. Again, it's just about income. 2-week trade. So if I'm only going to stay in this thing for 2 weeks, I really want to see what would happen. So I'm going to put my fence kind of where they expect it to move in November. And that is around the 24 delta. That's expected move, not the standard deviation of 16. So I say, okay, I'm at 24 deltas, which means it's a 48% chance it'll get either way, 50-50. I don't mind that. And then I will buy. So that's 48 for 43.5 and 47. Then I'll go in and get the protection at 43.5, 47. And that's December. Okay, so since we can't have 43.5, we'll go 43 in December, and we'll buy protection there, and 47. We'll buy the protection here. So we got 43. Even though the fence is closer, the thing is, if it moves against us going in those direction, it's going into what we call our long strike. So we got 43, 47. Oh man, I hate when that does that. So 43, 47. Let's go back to November. The Thinkorswim, that Thinkorswim, Tasty always does that when I move the strikes around. It's just really weird why it does that. So 43, 47, we're selling. Oops, we're going to buy the 43, 47 in December and sell the month that's before it, 43, 47 in November. Okay, wait, that's December. Let's go to November 15th. And we're going to go buy the 43, 47. Or sell the 43, 47, sorry. 43, 47. So we're selling those 43, 47 in November and buying the ones 43, 47 in December. This is a double calendar. You get paid 84 cents a day. And it'll cost you 74 cents to get into this trade. And now this is where this is where Thinkorswim excels in terms of its analytic, because it'll show you a curve, even though that expiration curve is not necessarily the right curve, but it's just a little easier to digest. But so let's see what we got here. So this is our hill, and since it has we can't really see where the expiration is because you're in a time spread, so you're not going to see the short, the strikes that we had before. But we can analyze this and say, okay, if we're going to get paid 84 cents a day, what would happen to this trade? Remember, if the market falls, you get more volatility. So if volatility goes up on this trade, say about all things being equal, if the market stays there and volatility goes up and just goes up, let's see if we can do per contract use instead of per contract. We'll see if this thing goes up. Okay, here we go. Let's reset this. And if volatility goes up, what would we be making? Okay, if volatility goes up 3%, 5%. Let's just double check. Our theoretical price would be up $16. Theoretical price. Theoretically, we'd be up there if volatility went up 6%. And this thing can, because remember, we're buying something low, and then this, in the volatility, we're seeing if it goes up. Now, since this is a time spread, we only want to be in 25% at the very most between now and November 15th. This is not a trade where we want to stay in to the end, because our long, it basically, we're buying volatility. So if we did this, we would be out, say 25, say at the latest, even though it's more than 25%, at the latest, we'd be out of this trade November 8th. So what would happen if volatility goes up? Say we get a 5% volatility between now and then, and we got the 8th of November. Where would our price be at the 8th of November? We'd be up a little bit. Just staying in this trade, we'd be up theoretically. It's showing out of $74 we spent, we'd be up 2/3. So we would have made about 60% of the cost of what it cost us, to get in this trade. And if volatility only went up 2%, we'd still be up 58 cents or $58 theoretically. That's just between now and November 8th. Okay, even if we backed it off to November 2nd, I think it's the other November 1st. November 1st. Just if all things being equal and this thing didn't move, our theoretical we'd be theoretically up 50. So we would have made. Yep, we made almost 30% of what we spent. So, at least that's the Theo price. Anything can change. If the market fell, we would be, say it fell a couple of bucks. Okay, then that's when we'd start losing. So, and again, we want to be in this trade no more than say November 8th. They're saying this thing can move $1.51 either way by November 8th. So we'll say $2. If this thing moves $2. So let's go 5. So $43. So theoretically we'd only be up $30 if this thing fell the expected move, and we got out in November 1st. And we had a 2% rise in implied volatility. Theoretically, we would be up, 31, we're not, it's like a little over 1/3 of what it cost us to do this trade. Just a little bit over 1/3. So, making about a little over 30%, between, in a couple of weeks, I don't mind that. And that's calendar. That's just literally just buying the volatility. This would be called a double calendar. That's the kind of trade this is. Double calendars. Normally you want to do those on indexes, and it's just because the index, it's just, it's totally liquid, and it doesn't, if it expires, you won't get assigned. If it expires where your short strikes are at, you won't get assigned. But this is just a regular double calendar. I'm going to keep this one in the wheelhouse, but I'm going to keep it in the wheelhouse at around, I'm going to keep it in there at around 80 cents, because our mid price is 74. What we're asking is 80. So I'll say 76. I'll say 77. And then I'll see if I could get filled with that at $77. Even though this is the kind of trade you'll want to do with, as an index. I don't mind doing a calendar in this just because the low implied 10 IV rank is very low implied IV rank. The implied volatility of itself is also low. So I'm going to keep this at 71 cents. See what happens. Okay, we got filled in that one. 71 cents. An EMM. So let's go to our positions. Or 77 cents, excuse me. So emerging. Oh, wait. I'm full. I'm a fool. I meant to go 73 cents. I went up the wrong way. So I got filled. I'm an idiot. I meant to get filled at the lower and not the top. I meant to go 73. So let me see what our trade price was. So I messed myself up by 3 cents. Duh. I meant to go 74, and that's it is what it is. It's only 3 cents. So I'm not gonna freak. But anyways, we're in the wheelhouse. Oops. My bad, brother Will. So I'm buying volatility and not selling it. So I bought the volatility at a higher price. I meant to sell it I was thinking I was selling it. I meant to buy it at 74, under the price, between the natural and the mid price, but I ended up buying it like an idiot. Oh, well, it is what it is. I'm not going to freak. It is what it is. 77. Okay, so I'm down $3. Okay, I goofed with $3. I'm not going to freak. I'm not going to cry, or I'd say $5. I'm not going to cry with it. I'm just going to say, oops. But anyways, we got a bunch of trades done that are still working, working their magic to see what's going to happen. IWM. Okay, all these. Okay, yeah, because IWM, did I? Yeah, I did. I did move that around. So we've got 3 other trades that were sitting to get filled. And again, they're not going to get filled right away because it's so far away from the price. But I'm just going to see what happens with markets later in the day in terms of getting these trades filled. So anyways, buying a volatility, you want to buy it cheaper and not do what I did. I'm still thinking I'm selling volatility, and I was like, okay, let me move it to 77 instead of move it to 72, which is where I should have wanted to buy it. Therefore, the market could come down and buy it from me. But somebody said, there's an idiot over here who just decided to buy this thing at this price. Sure, I'll sell it to him. I'll sell it. He doesn't know any better. Hey, KW, good to see you. Yeah. It is what it is. 3 cents is $3. Oh, well, that's commissions. My thing is I'm wanting to make 30% by November 1st. If I can make 30% by November 1st or 60% by November 8th, I don't mind that. Because I'm only going to be in this trade no longer than maybe 30% of the time between now and November 15th. I'm not going to wait till November 15th to take this off. It's one of those trades where you get in and you get out. Get in and get out. But that is, again, income trading. Again, this is all just about getting the trades in. I check my expected move. How far do I think it's going to go between now and November 15th, and then now in November 1st? And it's clearly like $1 either way, between now and November 1st. So that'll tell me that if it gets more volatile, number one, it'll give me some, it'll pay me. I've got theta, a little bit of theta, not humongous amounts, but I do get some theta. And then in the meantime, okay, we'll look at the metric. Let me open it up again for you. And time goes by. Every time goes by, you get paid. That's theta. Volatility, if it goes up in volatility, then you get paid. And what that does is it also balances out some of my other trades, because when you're selling, you want volatility to go down. When you're buying, you want volatility to go up. So now I've got more of a balanced volatility play. So if we looked at this, these little things at the top are your Greeks, okay? The Greeks. What this means is, since I'm buying volatility at this, where's that one I put on that I just goofed? EEM. So every day that goes by, I get paid 64 cents in theta. Oh, no, it cost me. Wow, why is it cost? It shouldn't cost. I thought I had. Oh, I know why it's costing me. I should have had 64 cents, but I paid too much for it. So I can understand why it's going to cost me. But that's going to change. No, that's my. Oh, no. Did I say theta? No. Theta. No, I'm making 82 cents in theta. I'm down 64 deltas. Okay, so I'm short deltas. I'm sorry. I'm thinking that's theta. The circle is deltas. So the triangle is deltas. So this is in delta, this is 64 cents short. So I don't mind that, which means, if a market goes up on me, then I lose 64 cents. But look at this on SLV. We're already 8 deltas. I'm not going to freak on this because 8 deltas, it's only down 14 cents. So I'm not going to freak. I mean, I could freak. We'll take a look at that. but 8 deltas in that and 8 deltas in FXI. These are the strangles I just put on. So I'm not going to freak too much unless it gets like 15, 16, or 20 deltas. But I get paid 82 cents a day to hold this. IWM, okay, these are all volatility. The ones in minus means when volatility goes out of the trade, you make money. This one, if volatility rises, it pays me. You know, the Vega is $5. Gamma is the only thing. These right here that are freaking me out right here means that for every dollar this thing moves, I lose $12. But since these are moving like 9 cents and 38 cents, I'm not going to freak. Over here, the thing that gamma here is if it stays where it's at and doesn't move, then I lose. I lose $4. So I'm not gonna freak. It's just one of those. I have to sit back and go, okay, this thing. I mean, no, if it moves too much, I lose $4. For each dollar it moves too much, I lose $4 in this thing. But I'm not gonna freak because the other stuff, the theta and the the 82 cents a day is going to take some of that steam off of it, and the theta of 67 cents is going to take some of that off if this thing moves $1. And keep in mind, it's only moved like 17 cents. It does have the ability to move $1, and I'm talking about EEM at the bottom. I'm not going to freak out too much. It's kind of like driving a stick, where you have your clutch and your gas. That's all this stuff is. You want to balance your theta, your delta, and your vega. You want to balance it so if you're short one, you want to make up for a little bit on the other. And it's no different than driving a stick. And I drove stick for years. I mean, years and years. That's all this is. Trading options is like driving a stick. You're just balancing stuff up so you can keep the credit coming in. So you're not, so you're always making money, and money comes in every day. And that's all this is. Oh, I thought I shared the screen. My bad. Let me share the screen with you. I totally forgot. Let me show you. So let me share the screen. I forgot to do that. Share the screen. Application. Okay, let's do that one more time. We're gonna try it again. Tasty Works. Yeah, my bad. I wasn't even thinking. I was like, oh yeah. So let's share the screen, and then I can show you better than I can tell you. Yeah, that's all trading is like driving a stick. You're balancing as much as you can. Okay, so if we look at the very bottom, our deltas, which is the triangle, our deltas in terms of if this thing moves one way or the other, $1, we're going to lose 72 cents. And I'm not going to freak too much on that because this thing has barely been moving all day. Oh man, come and give me a price. What's going on with the market? Okay, there we go. Every day that this thing goes by, we make 87 cents. Now, if volatility goes up $1, like when the market moves, it gets more volatile. So we'll make $5. If it moves $1, we'll make $5. I mean, if the volatility goes up. But if it moves $1 either way, we'll lose $4. So it kind of balances out between theta and volatility balances out between the gamma, which is the acceleration of moves, So it that's the thing that I really get afraid of is our gamma, because if this thing moves $1, then it adds $4 to to whatever we're losing, $4.60 to whatever we're losing. But since we have Vega, when things move, volatility should go up a little bit, especially if it moves down. And if that does, then that we're making $5 per dollar move or per point of volatility that goes up. So I mean, it kind of balances itself out, and that's the very bottom one. This is your delta. This is your theta. This is your gamma. I mean, this is your your Vega, and then this is your gamma. In terms of and your delta is how far it moves up and down. Your Vega is your volatility, how volatile it gets. Per each point of volatility, you get paid a certain amount of Vega. For us, we get paid 87 cents. Then your theta, excuse me, for each day it goes by is your theta. You get paid 87 cents. Your vega is volatility. If it goes up 1 point or goes down 1 point, it's the difference between about $6. And the movement in and of itself, the acceleration of the movement is your gamma. And each dollar that it moves, you have 70 cents of of delta, then you have to add about $4.60 of gamma for how much of a move that you get. So we want that vega to kind of pay for it and the theta to pay for it. So each day that goes by, you get paid 87 cents plus the $5.90 of vega for this thing being volatile. Because it's hard for a stock to move and not be volatile. So it's like driving a stick. They kind of balance each other out. You just want to make sure that the balance is in your favor in terms of your vega theta ratio to your gamma delta ratio. You want to make sure that things balance out a little bit so you're not losing, and you're, at the very end of the day, you might be net 30 cents, and that's the main thing. But all in all things being equal, we want theta to work its favor for us. So November 1st, if this thing, all things being equal, and this thing doesn't go up in terms of percentage, in terms of vega, and it just stays there, cool. Because the theta will pay us. Each day that goes by will pay us. And that's cool. I don't mind that. For each day that goes by, you get paid for if a market doesn't move. As long as volatility doesn't go down, you'll still get paid. And as each day goes by, you'll get more and more you'll get more and more theta. And and that's what I'm looking at on this trade. Like if each day that goes by on this trade, if we go to our theoretical on EEM, let's go to EEM, all things being equal, with all things being equal, there are theoretical on EEM. Let me just today reset. On this, let's do this. Let's duplicate this. We'll do an analyze the same trade we just made. Let's go to field EEM, similar order. Yeah, see, I should have gone down instead. This is 73. I should have gone down to 70, and that would have saved me some. If we would have gotten filled, or 72, we would have gotten filled. Would have saved me $5. Don't. Anyways, let's analyze this. Theoretical. Let's see. Theoretical or profit Theo. Why are we looking at that? 1024 per contract IVs. There we go. Per contract IVs, we reset these. Say if we left the volatility exactly where it is. Okay, exactly. Totally where it's at. Let's get our price up to 77 because that's my doofusness. No, not this price. We'll add $7 because I goofed, and that was the price. We'll add $5 to this, so 531. Okay, that we'll say that's our theoretical. Say if all things being equal, and this thing moves to November 1st, we'd be up $12. If all things being equal, the theta alone will give us that, which is not a lot, but it's saying, hey, all things being equal, if we just market doesn't go anywhere, volatility doesn't change, it just stays completely flat, which is not going to happen. We could get out of this at $12, which means more than likely we would hold it beyond. Wait a minute, here's November. $14, which means more than likely we would hold it to the 8th at the very latest, and then we'd make about 30%. Holding this to November 8th, we can make 30%. All things being equal, market doesn't move, doesn't get volatile. There's volatility doesn't go up, nothing happens. All things being equal, we could probably make about 30% on this trade. 30% of what it costs. So it's not like but when you're doing like SPX calendars and stuff like that, and then you're doing like more than one contract, that's where things start to build. That's where you're like, okay, I like this. You're doing calendars and SPX, SPY, E-mini ES, NDX NASDAQ, the NASDAQ futures. We'll get into that later. When you start doing that, then you're talking about when you do it when volatility is low, not when it's high. You'll do that. And so, that just, gives you kind of the idea. We got some trades, some income trades. We're going to fill them up, and hopefully the other three will fill. And we'll just keep monitoring, monitoring just, the ones that are down, the FXI and the SLV, which, are down deltas. I'm not going to freak until I see later in the day if I'm like down 15 deltas. Then I'm going to start saying, okay, I'm going to have to look at this a little bit differently, in terms of the P&L. If it's down a big P&L, then I'm going to say, okay, maybe we got a trend developing, and maybe I'll just monitor it closely to see if I have to move strikes around. Remember, every time you get into a trade, you'll know you're going to adjust it. It's not an if, it's an actual guarantee. You will be adjusting every trade when you get in. Anyways, hopefully that helps. KW, always good to see you. There you go, Brother Will. And we'll see what happens tomorrow. Y'all take care.